We know that recently there have been a lot of tax changes, and as we begin almost a new era, the beginning of 2019, business owners and those professionals who are proactive and incorporated, they've got some new issues to deal with when it comes to taxation. Is that correct?
Yes, that is. The new passive income tax rules came into force January the 1st. So really anyone who has investments after their corporate tax are going to be taxed at 50.17% here in Ontario. And then of course there's taxation on getting that money out of their company as well through a taxable dividend.
So if that's the problem, what are some of the solutions that we can apply?
Corporate owned life insurance, which is part of the Tax Act, and it doesn't have to be owned personally. Most people with substantial wealth who are incorporated actually own their policies within the corporations. That policy can be paid for with a corporate dollar as opposed to a personal dollar that has to go through the tax cycle. And then they can now take money that would be subject to passive income and actually put it within their insurance policy. Now that no longer is going to be taxed at 50.17%, and it grows tax-free, and as I mentioned, can be accessed tax effectively. And upon death, the proceeds from the insurance and any of the values that have been built up actually get credited to the corporation's CDA, their capital dividend account, and all of that money can come out virtually to their beneficiaries.
So when I hear that, I hear tax-exempt growth, and you're creating a future ability to withdraw money from the corporation, again without paying tax as you normally would on dividends.
Correct. That if it's structured properly, that would be the case. There still has to be an insurable risk here. It's not just for tax purposes. There are needs for income or for liquidity, or it could be for key person usage. So really, there's no cookie cutter here. Each situation is different, and it's really understanding how that business works and how this could fit in.
And it almost sounds like it's a way to deal with some of the retained earnings and so on. Is there anything more you'd like to tell us about that?
Well, the other thing with the new passive income rules is the government is actually penalizing people for keeping more than $50,000 of retained earnings. And that will now reduce their small business deduction, which means by default, keeping money in retained earnings that are now passive can see an increase of up to about $65,000 of tax that didn't exist last year. Corporate-owned life insurance is a great way to address that, to be able to make sure that you preserve your estate for your family or for charity or for both.
Well, excellent. And I think we're always needing to stay on top of proactive solutions, which many people don't really take advantage of. I really hope you've enjoyed this video. We're pleased to have Mark Halpern of wealthinsurance.com with us today, an outstanding firm in the insurance market that we've been pleased to work with.
Well, we're really so fortunate to partner with Wealth Stewards, who is really the preeminent financial planning firm in Canada, and we're delighted to be helping clients together.
If you'd like to contact us on any of the topics that we've gone through, please give us a call. You can reach us at 905-891-6052, or you can reach us via our website at wealthstewards.ca. Thank you.